Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right, so let's look at the benefits of then and review the benefits. Again, I'm not, this isn't a sales pitch for using debit spreads by any means, but, particularly if you're looking to limit your risk exposure and your cost per position in a market that is extremely volatile, this is a great and very simple way to do it. So don't worry about trying to create these extremely advanced strategies. Focused on some of the basic ones right now. Your drawback, if you could see it as a drawback, is your limited profit potential. Okay, but any profit is a good profit when you're considering the alternative. So look at this as a way of lowering your costs in an extremely volatile market, limiting your risk exposure, at the cost of also limiting your profit potential. Okay. Now, one of the things that you will notice is that you need to see some time to pass for the profitability of this position to widen out, because part of what is working in your favor for this particular strategy is also that time depreciation. So a really fast move in this may not necessarily reap the returns that you're anticipating, because your time component, that out-of-the-money option that you've sold, hasn't had an opportunity to start to drop in volatility or lose time value, which will happen faster than the one that you purchased, which is near the money. Okay, so hopefully I explained that sufficiently. I don't know, Steve, if you want to add to that at all, but again, you want this to widen the time, a little time to pass for this to start recognizing the full profit potential.
Yeah, I just would like to add one point, that spreading is a more moderate strategy, and I get this question very often from attendees, whether it's live or via these webinars, that they find an underlying, and all of a sudden they put on a spread, and they're, like I said before, they're, quote unquote, they're really, really right. Well, if they're really, really right, as Jason said, it will require some time to pass, because the option that you sold it may have all extrinsic premium, so you may not get your maximum profit. So if you knew, and none of us do, if you knew that you were going to be right all the time in a big way, what would you do? You'd buy simple calls or simple puts. But this is a more moderate approach relative to just buying calls or puts. So you're not going to get the big upside swings, but also you're going to moderate your losses.
Good stuff. Good stuff. Okay, so a couple of things to think about, guys. We're going to sort of work into wrapping things up here. Don't necessarily rely on market timing. That is a large component of what we've been discussing here throughout the presentation with respect to watching, and creating a directional bias and so on and so forth. But you really want to take a little bit of time and weigh out your risk versus reward scenarios, and that means pricing out just the idea of buying a straight call option. What expiration, what strike price is appropriate for your market outlook? What strategy are you looking for a very significant move and therefore only don't want to limit your upside potential, or are you just looking for a short-term play into a key target area? So don't just rely on that sort of generating that directional bias. Take a little bit of time to measure out the profitability of applying either a straight call or a straight put, or combining those options by creating a more advanced strategy before you go in and just inadvertently start trading the opportunity. Strategy selection, again, understand the components. I mean, buying a call, buying a put is a relatively easy prospective way to participate, because you're buying to open, you're selling to close. It's one of the easiest approaches to using options that one might execute, but recognize that as you get into some of these more advanced strategies, depending on the broker that you're trading with, they may or may not have mechanisms in place to make the offsetting of these positions easy. And I know Interactive Brokers does, for example. Options Express, 100% great template for managing these types of strategies. I'm not sure about E-Trade. I don't think so. TradeStation, any of these Thinkorswim, I'm not sure. But that's something you want to consider. Make sure you understand the complexity of the strategy so that you can manage it effectively and you understand what market conditions influence the profitability. As I mentioned, a key component with the spread is that time depreciation aspect of it that you need to see take place. If this thing shoots off in your direction very, very quickly, you might step back and say, wait a second, I'm losing here. Well, reason being is both options are profiting. And so you need to see that rate of time depreciation take place. So something you need to keep in mind. It's one of the variables to consider when you're creating a more advanced strategy. Trading too many opportunities. I throw this in with all my, regardless of the market that I'm discussing. But again, make sure that if you're starting to take advantage of some of these, whether it's in the FX options market, whether it's in the equities market, don't be trying to juggle more positions than you can handle. It's prudent to go in and manage a few of them, create a methodology that lends itself to managing multiple strategies, and then build on that. Don't pull in, don't buy puts and calls on all of the different pair values, and then have trouble managing them as they're moving in different directions. Take a little bit of time and make sure that you're managing them effectively on a per opportunity basis. And finally, recognize that you don't have to get fancy to make money on these FX options pair values. It's always nice to understand and to learn these advanced strategies, and there's certainly some benefits in understanding them. And in fact, we'll be doing an advanced FX options strategy seminar as we move forward into the future. But recognize, if you're just looking to start out, if you just want to kick the tires here and just trade your views but keep it real simple, then look at using just a straight call or a straight put, or look at using a bull call spread or a bear put spread to participate. And then as you feel comfortable with those types of strategies, then you could actually evolve into using some of these more advanced type combinations that we'll be talking about in the future.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.